All right, welcome to the Explainer. Today we're going to unpack a really powerful financial strategy, one that's actually built for the kind of volatile economy we're seeing right now. It's a pretty sophisticated tool, and honestly, one that a lot of investors just completely miss. But it's designed to protect your portfolio while generating some pretty significant tax-free income. So let's get right into it. If you're an investor, especially if you're in a higher tax bracket, there are these two, well, silent killers, really, that are just constantly chipping away at your returns. You work so hard to make money with your portfolio, but it feels like before you even get your hands on it, a huge chunk just vanishes. Now, I know what you're probably thinking. A boring bond paying you more than some high-growth stock? That sounds pretty wild, right? It sounds almost too good to be true. But stick with me here, because by the end of this explainer, you're going to see the actual math that makes this whole thing tick for a lot of investors. Okay, so here's how we're going to break this all down. We're going to start with the big problem that pretty much every investor is dealing with right now. Then we'll introduce the key players, build the strategy itself, and finally take a hard look at what the real-world returns actually are. So let's kick things off with that big problem. So right now, every single investor is facing this 1-2 punch. You've got taxes coming at you from one side, which you can see coming, and then you've got inflation from the other side, which is much more like a silent thief just sneaking away with your wealth. Let's tackle taxes first. This is a big one. If you're in that top federal tax bracket, a whopping 37% of the interest you make from a lot of common investments, like corporate bonds or even high-yield savings accounts, poof, it's gone, straight to the government. So that 5% return you thought you were getting, yeah, it's really more like 3%. And that's before we even talk about our other problem. And that brings us to inflation. Man, this one is sneaky. It's this quiet but incredibly powerful force that makes your money worth less and less over time. I mean, think about it. If your portfolio is up 5%, but the price of everything else, gas, groceries, you name it, went up 3%, you didn't really gain 5%, did you? Your actual buying power only went up by 2%. It's a brutal reality that a lot of people just forget to factor in. Okay, so how do we fight back against this double team of taxes and inflation? Well, this leads us to our first piece of the puzzle. And it's an asset class that honestly is massively misunderstood and often just completely overlooked. It's called a municipal bond, or a Muni for short. And at its heart, it's a really, really simple idea. You're basically just lending money to your city or your state or maybe a local agency. That's it. It's just a loan, the same way a corporate bond is a loan to a company. But what's so cool about these is that you're not funding some abstract corporate balance sheet. No, you're funding the real, tangible world around you. We're talking about new schools, recreation centers, bridges, toll roads, the actual infrastructure of your community. It's something you can see and use. Okay, now for the magic trick. This is the superpower of muni bonds. To encourage people like us to invest in these public projects, the federal government decided to make the interest you earn from them completely free from federal income tax. Yep, that 37% tax bill we talked about earlier. With munis, at the federal level, it's just gone. This is the absolute game changer. All right, so before we can actually build our strategy, we need to get a handle on two fundamental rules of the game in the bond world. Think of these as the core trade-offs that really drive everything. First up, the classic, risk versus reward. It's super simple. You take a bond from a rock-solid, stable company like Sanofi, right? It's seen as super safe, so they don't have to pay you much in interest, maybe just 1.23%. But then you look at a company that's on much shakier ground, like Bed Bath & Beyond was. To get anyone to take on that risk of them going bust, they have to offer a huge yield, like 7.68%. It's as simple as that. Higher risk, higher potential reward. There's no free lunch here. Okay, trade-off number 2 is all about sensitivity to interest rate changes. And this is tied to something called duration. Just think of it like this. If you have a 30-year bond and interest rates suddenly go down, your bond becomes super valuable because you've locked in that high payment for decades. But if interest rates go up, your bond's value can totally tank. Now, a short-term bond that's due in, say, a year or two, it's way more stable. Its price doesn't swing around like crazy because you're getting your money back soon no matter what rates do. Okay, so we have our building blocks, right? We understand risk versus reward, and we get the whole sensitivity versus stability thing. Now we can actually build the strategy. And the big idea here actually comes from Nassim Taleb, the guy who wrote the book The Black Swan. His whole philosophy is basically avoid the messy, unpredictable middle ground. Instead, you build a really strong, resilient portfolio by going to the two opposite extremes, the super safe and the super aggressive. And here's why that's so smart. When you combine these two extremes, you end up with a portfolio that's kind of ready for anything. One side is your rock-solid foundation, giving you stability and predictable income. The other side gives you that shot at big returns. You get this amazing, unique blend of both safety and opportunity. So how do we do this with municipal bonds? It's beautiful. On one side of our barbell, we have the anchor. This is the big part of your money, like 80–90%, and it's all in those ultra-safe, AAA-rated, long-duration bonds. They provide that stable, tax-free income. Then on the other side, you've got the booster. This is a much smaller slice, maybe 10–20%, in those riskier, high-yield, short-duration bonds. This is what gives the whole portfolio a serious kick in yield, all tax-free, and it helps protect us if interest rates start to rise. Okay, so we have the plan. The blueprint is drawn. But a plan is just a piece of paper until it meets reality. And now we have to once again face that silent thief we talked about earlier, inflation. Look, it is so easy to fall into this trap. You see a bond offering a 5% yield and you think, hey, that's pretty good. But that number, that headline yield, is totally misleading. It's practically meaningless if you don't look at what's happening to the value of your actual dollars. The math is dead simple, but it's probably the most important calculation you can make. You take your bond's yield, say 5%, and you just subtract whatever the current inflation rate is. Let's say it's 3%. The result? Your real return is only 2%. That's the only number that matters because that's how much your actual purchasing power is going up. If inflation was also 5%, guess what? Your real return is 0. You're not making money, you're just running in place. So you might be asking, why are we going through all this trouble? Barbells, real returns, what's the ultimate payoff? What's the big takeaway here? Okay, let's put all the pieces together and you'll see why this is such a powerful tool to have in your back pocket. Here's the thing, you can't just look at the yield on a muni bond and compare it directly to the yield on a corporate bond. It's a total apples to oranges comparison, all because that muni income is tax-free. To make it a fair fight, we have to figure out what a taxable investment would need to pay you just to equal the muni's return after you pay your taxes. And there's a name for that. It's called the taxable equivalent yield. And boom, this is where it all clicks. Just look at this table. If you're in that 37% tax bracket, the S&P 500's average dividend, after taxes, it's less than 1%. A decent corporate bond paying 3%, you're only keeping about 1.9% of that. But our 5% high-yield muni, you keep the entire 5%. Now look at that bottom line. For a regular taxable investment to give you that same 5% in your pocket, it would need to have a stated yield of almost 8%. Think about that. Finding a relatively safe investment paying nearly 8% is, well, it's darn near impossible. That is the incredible hidden power of tax-free compounding. So what this strategy really does is it takes something people think of as boring, bonds, and turns them into this really dynamic tool that can help you fight inflation and hedge against interest rate swings, all while generating serious tax-advantaged income. And it really leaves you with one big question to think about. In a world with high taxes and stubborn inflation, is the safest part of your portfolio actually built to help you win, or is it just treading water? Maybe it's time to look beyond the usual suspects for real, tax-efficient growth. The answer might just be hiding in plain sight.